Hello everyone, welcome to the net. Hello everyone, welcome to the ninth lecture of Management 202. In this lecture, we'll continue talking about capital structure, and um, after we finish, we'll do a review. Hello everyone, welcome to the ninth lecture of Management 202. So in this recording, we'll continue talking about capital structure. And if you remember, in the last recording, we started with a perfect capital market or a perfect M&M world, meaning that in this world, we're going to assume away a lot of frictions which happen in the real world, right? And remember, what are some examples of them? Right? Transaction cost, right? Corporate taxes, assuming individual investors have the same ability to borrow and lend with institutional investors, right? Many stuff like that, right? Which simply does not happen in the real world. And we have looked at how Modigliani-Miller, right? How M&M theory explains the effect of capital structure on firm value, right? And also on the risk of the firm, right? And our conclusion is that in the real world, right, in the real world, capital market actually does not relate with the firm value, right? So these are the two propositions of Modigliani and Miller, right? The first proposition basically says, well, capital structure does not matter, right? No matter how high your leverage is, the levered firm value is always going to be the unlevered firm value, right? That's proposition one. And proposition two says, well, the cost of levered equity is going to be in an increasing function, right, in the leverage ratio, which is D over E, right? In this case, right, meaning that the higher leverage ratio you're going to have, the higher cost of levered equity you are going to have, right? However, right, we want to know that even though cost of equity is increasing in the leverage ratio, but the overall WACC, right, should remain the same, right? The overall WACC should remain the same because the firm value remain the same, and also our cash flow remains the same, right? So our WACC has to remain the same for both unlevered and levered company, right? And we have shown how those formulas are derived and examples of those, right? And hopefully you'll understand, right, why in a perfect capital market these two propositions is true, right? And so given those two fundamental, right, two fundamental theories, and we want to maybe think about considering those frictions in that actually happen in the real world, right? Because if this is the case, then corporate finance is not interesting at all, right? Because the firm should have no preference for any capital structure, right? And we won't see such a cross-sectional difference, and also the time series difference, right, variations in firm's capital structure. Okay, so let's consider, making our simple world more similar to our real world, right, by adding four different type of frictions, right, one by one, right? So remember, what are those four type of frictions, right? So first of all, corporate tax, right? Corporate tax, which is the most simple and also a very important factor, which can change companies' preference for debt and equity, right? The second one, cause of financial distress, right? It means that when leverage is higher than a certain amount, right? Because companies want to take advantage of the tax benefits by levering up, right? However, after reaching a specific level of debt, right, companies would want to consider not raising it anymore because if the company keeps raising its debt, it will have a higher and higher responsibility to pay back its to its debt holders, right? To pay the interest payment and also to pay the principal value or the face value, right? For the borrowings, right? However, if the company has too much debt, right, it will run into certain difficulties, right? First of all, difficulty of not paying back the debt, right, which will cause concerns from its investors, right, on how if the company will go into bankruptcy, right? And if there's a likelihood that the company is going into bankruptcy, right, then the company needs to go through certain procedures which are very costly and could reduce the company's value by a lot, right? And also because companies face financial distress, right? Meaning that the suppliers of the company will worry that the company cannot pay their money back, right? And also the customers of the company will start to worry about the quality of the product, right? Because you don't want to buy a car from a company that will go into bankruptcy, right? Because in the future there's no way for you to repair a car because the car's parts will not be produced anymore. Right? So the customers will also worry about a company's financial distress, right? So when a company has too much leverage, right, it is likely to incur these difficulties from all sides of business operations, right? And also, employees, right, would not want to stay on a sinking ship, right? Meaning that you will also likely to see employees, either leaving their jobs by themselves, right? Or you have to fire some employees to save money, right, for your liquidity to pay back your debt. Right? So there are all sorts of things happening, right, because of cause of financial distress. Meaning that company want to really consider, right, a good level of debt, right, so that it doesn't fall into financial distress. Right? So here, right, we have explained using using an example of how increasing a certain amount of leverage or a certain amount of borrowing can help the company reaching a higher value, right? A higher value to its investors. And then we talked about how to value this tax benefits, right, using the perpetuity formula, right? And then we talk about the second, right, the second type of frictions, which is financial distress, right? And here I want to highlight this using example from Six Flags, right? I think everyone knows Six Flags, which is sort of like a Disneyland with its amusement park, right? So I have here a report actually from 2010, right? So during that time in 2009, Six Flags wasn't operating very well, right? Think about the financial crisis. If you people do not even have a house to live in, and then probably going into amusement park is not really a good option for them. So at that point of time, when the economy is not doing very good, right? People save their money and cut their spendings on entertainment, right? So companies like Six Flags are particularly affected at that point of time, right? So in 2009, Six Flags filed for bankruptcy through Chapter 11, right? And if you remember, we have two ways to file bankruptcy, right? If you want to file through Chapter 7, right, it means that you're going to sell everything that your company owns and pay the money back to the lenders, right? Right, to the debt holders, right? So during that process, your company will not exist anymore, right? Because essentially you have liquidated everything about it. However, there's another process which a lot more companies, especially those large companies, will likely go through, which is called Chapter 11, right? Meaning reorganization. Okay, meaning reorganization. So during this process, the company will not be liquidated fully, right? And instead, the bondholders will step in and take control of the company from the equity holders. Right? So in this way, the bondholders essentially have transformed their debt, right, into equity and replace the existing equity holders. Because if a company went into bankruptcy, essentially the equity has no value at all, right? So the existing equity holders or the previous owners of the company will be replaced, right, by actually its existing bondholders, right? So in this case, right, let's take a look at this reporting. Six Flags emerges from bankruptcy, right, and theme park operator, right, emerged from Chapter 11 bankruptcy, right, in 2010, right? Meaning after reorganization, right, the theme park start opening again, right, to the public. So let's take a look at how this reorganization actually worked. Right. So from Chapter 11 bankruptcy on Monday, after wiping out more than $1 billion of debt by turning the company's ownership to bondholders, right? So what does that mean? It means that actually there was at least an amount of $1 billion of debt, right, owned by Six Flags, right? And Six Flags is not able to pay back this debt, this amount of debt anymore, right? So what it did is that it filed bankruptcy, and the owners or the bondholders of this $1 billion debt, right, of this $1 billion corporate bonds, becomes the owner of Six Flags. And then essentially this $1 billion of debt, right, this $1 billion of debt changed, was removed from its ownings, right? It was removed from its debt and instead become their equity, right, in Six Flags. Right? So the company, which operates 19 parks in North America, enters this high season without the constraints of bankruptcy because it doesn't have that much of debt anymore, and with less than half of its debt, and it had filed for Chapter 11 last June, right, in 2009 June, right? So during this Chapter 11, right, this is how company reorganize itself, right? The bondholders is going to take control of the company, right, and replace the existing equity holders, right? And by doing that, they will also convert their bonds, right, into their own equity, into the new capital, right, new equity of the firm. Right? So the company now has more financial flexibility, right, to attract more families, right? And also that's the time when economy starts to sort of revive, right? After in 2010, right? The company exit bankruptcy, right? And under the control of hedge funds such as Stark Investment, right? Those hedge funds were, the bondholders of the company, right? The funds owned this bond, invested this amount of this millions, right, to recapitalize the company, right? So you see this amount of money, right, $725 million to recapitalize the company, right? This is the amount of money that the company needs to spend, right? Needs to spend to go through this reorganization process, right? Just look at how much money this value is gone, right, from the firm value, right? So this is a very costly process, right? Again, right? Bankruptcy costs, very costly. You need to pay lawyers, you need to pay the court, and you need to, settle down the disagreement between a lot of, parties with interest. Okay. Okay, and then the article explains some, other informations on the company, right, and some quotes from its investors, right. We never believed the company couldn't support this billion amounts of debt, that one of the directors said. Okay, so this is an example of Six Flags, right, going through Chapter 11, right, going through Chapter 11 for its bankruptcy process, right? So this is I hope this provides some examples in understanding, right, financial distress, right, and how companies will go through these two type of procedures, right? For Chapter 7, right, I didn't find many good examples that everyone know, right? But I did find some examples of certain brands, fashion brands, right, file for Chapter 7 bankruptcy. So one of the example is something called Roberto Cavalli, right? And another example is this brand, right? This called Avenue, right? This brand Avenue. I think this one is more seen, right? I think there is one of this store in Rancho Cucamonga, right, in the Victoria Garden, right? So this store also filed for this store for Chapter 11 bankruptcy, and 3 months later, right? I believe that maybe Chapter 7 is a better way to liquidate this company, right? To resolve this issue. Right. So this company listed assets of 50 million to 100 million, and the liability of 100 million to $5 million, right? So you see that the value of the company is significantly below the amount of debt it needs to pay back, right? So this is one reason that it needs to file for bankruptcy, right? Also giving the COVID situation right now, people do not spend a lot of money on fashion brands anymore, in theory. Okay, so these are some backup materials for the first two type of frictions, right, in the real world, right, which is quite important and quite influential on companies' decision for their best leverage ratio, right, for their balance of debt and equity, right. So if you think debt is beneficial for tax purposes, right, companies will increase their leverage. However, at a certain point of time, right, the benefits from tax will be smaller than the benefits from the than the cost from the financial distress, right? So this is why we're going to reach, a trade-off curve, right, for the value of the company in terms of the value of debt, right, as shown in this graph. Right? So at a point of time, it will reach the maximum, right, and then will drop, right? If we consider both frictions in the capital market, right? So we're going to talk about something new today, right, which is about the third and the fourth friction that actually happen in the real world of capital markets, right? And across different type of capital markets, those costs, right, or those frictions will be a little bit different, right? For example, like in China, right, you can think of a financial system which is less stringent, stringent than the U.S. market, right? And then there might be some loopholes, and sometimes there might be stronger conflicts between interested parties, right? Between, for example, equity holders and debt holders, right? Or between CEOs and equity holders, right? Than the situations in the U.S., right? So in different market will have different sort of characteristics. So you may find a slightly different conclusion, right, on how agency costs, for example, or the fourth friction, which is asymmetric information, right, will have an impact on the outcome of capital structure. Okay, so let's first talk about the third friction, which is agency costs, right? So now you should be pretty familiar with the word agency, right? It means basically the conflicts between different agents, right, who has different roles, right, in terms of how the company is going to do their businesses, and also have different incentives on the company, right, from the company. Okay, so agency costs are the costs that arise from the conflicts of interest between different stakeholders, right? So here, stakeholders might suggest, managers, right, and or shareholders, right, meaning equity holders, right, or debt holders, right. Remember, these three agents, right, are sort of represents three main forces or three main roles that that are actually quite important in playing out the company's main decisions, right, in terms of financing decisions, finance decisions, right. So if you think about this, right, we can sort of summarize those conflicts actually between different parties, right, between different parties. So here, I want to add another one, which I actually did, right, in the later on slide, right. So let me add here between also insiders and outsiders, right, meaning people who know more and people who know less, right, and also insiders will likely be the ones that has a higher ownership and a higher control of the company than the outsiders, right. I'll talk about some examples and show you what are some examples on the conflicts between insiders and outsiders. Okay, so let's first think about the conflicts between the first two agents, managers and shareholders, right? So we're gonna have something that's called managerial entrenchment and moral hazards, right? So what does those concepts mean, right? So here's sometimes for terminology, right? So it's actually pretty simple to understand, right? So I'll show you some examples on how to understand, right, different type of conflicts. Okay, so first. The first conflict is between manager and equity holders, right? So if you think about it, a lot of times, right, a large amount of control of a company is held by the managers or simply the CEO of a company, right? So in this slides, right, later on, if I refer to CEO, you'll know that it's basically, a representative of the managers, right? Someone who makes the main decisions, right? Who mainly makes the decisions for a company, right? So there's something that's called separation of ownership and control, right? If you think about it, a lot of companies will have a CEO acting as the main role of making, the major decisions of a company, right? However, a lot of times those CEOs are hired from outside of the company, right? So if you think about it, right, a lot of the company CEO are, hired from maybe some other companies, right, which are actually not one of the founders of the company, right? So what it means is that, they normally will have a very low ownership on the company. However, have a large control of the company, right? So this is the separation, right? This is what separation of ownership and control means, right? Probably they only have, like, say, 5% ownership of the company, right? However, they will have 95% of the control of the company, right, in terms of making decisions, right? So this separation of ownership and control is going to cause some issues, right, on the manager's side, right? Because, well, as a manager, right, if you can have a large amount of control of a company, and if you have the incentive to increase your self-interest or your self-benefits, right, and then sometimes you're going to make certain decisions that is actually not at the best of the company, right? So instead of maximizing the firm value, sometimes managers will have incentive to actually maximize their own interest, right? So, and some of these examples is what we call, is related with what we call managerial entrenchment, right? Because a position of CEO or a manager of a company is very attractive and is very rewarding, right? So a lot of times CEOs will have the incentives to engage in projects that actually makes herself or himself replaceable, right? So some examples is that, it might engage in something called empire building. Okay, so if you think about the word, right, the meaning of this word, right? So if someone wants to build an empire, right, one result of doing that is that, the larger, company or the larger nation that you have built, the more irreplaceable that it's going to make you, right? Because you're taking control of a lot of things, and for a new guy to replace you, he also needs to know a lot of stuff and have a lot of connections with many different parties, right? So it makes you sort of hard to be replaced by outside, by someone else, right? So an example of empire building could be, undertaking certain wasteful projects, right? Maybe meaning like making a large amount of investment into some projects which may not make quite a lot of sense, right, for your own company. Right? So here we have an example of like an acquisition, right? If you think about it, a company is acquiring, right? Company A acquiring company B is actually an investment project for company A, right? So a lot of the times, these acquisitions or mergers and acquisitions is not a very good, right, investment project for the company to take. So here I have listed example, which is the very famous example acquisition of AOL on Time Warner, right? So in 2000, these two companies get together, and actually AOL is the acquirer at that time, right? I think it's not this one. Right here, right? So there's a report on, say, let's top 10 best and worst, right? So this is actually example of worst, what top worst mergers and acquisitions, right? So at that point of time in 2000, at the height of internet craze, right? You remember at the point of time there was this dot-com bubble, right? So in 2000, a lot of internet company had a really high valuation, and they don't know what to do with the amount of money that they have raised from the capital market. So at that point of time, there are a lot of crazy stuff going on, right? So in 2001, the old school media giant Time Warner, right, consolidated with American Online, right, the internet and email provider of the people, for a whooping $111 billion. Okay, so it was considered the combining of best of both worlds, right, print and electronic together at last. Right. So, but the synergy of these two dynamic different companies never occurred, right? The dot-com bust and the decline of dial-up internet access which AOS refused to give up, right? So at that point in time, the technology of internet is not like a fiber or like a modem, like right now, right? So at that point of time, they still use the telephone line, right, to do the dial-up internet access, right? You hook up with the telephone line, right, to your desktop, and then you will hear the beeping sound, right, and wait for the signal, right? So at that point of time, AOL refused to give up this old technology and maybe investing in new technologies, right, which sort of spelled disaster for the new company, right? Since the merger, Time Warner stock had dropped 80%, right? In fact, this past May, right? This article is, let's say when is this article? This article is sometime around 2009, right? 2009, like around 8 years, right? 8 years after this. So coming back, right? Time Warner stock dropped 80%. This May, the CEO of Time Warner, right, Jeff Bezos, right, embarrassingly announced that the marriage of AOL and Time Warner was dissolved. Right? What does that mean? It means that at that point of time, this new company, the combination of these two, right, actually made a decision to split off AOL from Time Warner. I mean that actually they think AOL is not worth of remaining in the company anymore, right? So they split off the AOL's operations, right? The division entirely. Right? So a marriage and a divorce, right? A marriage and divorce. So before the marriage, they think they fit each other pretty well, right? However, at that point of time, you cannot reject the hypothesis that it might be something that is going to benefit the owners or the CEOs of these two companies, right, to get together, right? And there was a lot of money involved in making the deal, and I don't think it was very carefully thought it, and before they merge with each other, I don't think there was an agreement on what the companies should do, right, in the future, right? So you can think of those as a very good example of empire building, right? Meaning that the CEOs wants to increase the scale of the investment of the company, right? And in some extent, right, making herself highly irreplaceable, right? And this is what happens to AOL and Time Warner, right? And later on, it was proved that was a very, very bad decision for all the shareholders of the company, right? So rejecting, another important, right, example of managerial entrenchment, right? So if you think about this, managerial entrenchment, it means like certain actions that entrench yourself, right? Protect yourself as a manager, right? Without being replaced, right? So another example is sometimes, companies will attract, right, other companies, right? So also an example over here is from the restaurant.com, right? I don't know if you're familiar with this website or app, right? So I think 5 years ago when I was a PhD at Ohio State, I remember this app like from where you can buy these coupons, right? So it's sort of like a Groupon specifically for restaurants, right? So there are a large number of restaurants listed on this restaurant.com, right? And what you can do is that you can buy sort of like discounted gift card, right, to shop, to use it at a specific restaurant, right? So for example, this $25 gift card, which you can use at Red Lobster, is going to be sold on restaurant.com for about $15, right? So if you really have the demand, right, to use to dine in Red Lobster, then it's a pretty good deal for you to buy the gift card before you actually go there, right? And then you can save $10 if you redeem the gift card. So it was quite popular. At one point of time, it was quite popular, right? At least in Ohio, right? Because around the campus, there are lots of restaurants which you can actually use it, right? And I thought it was very handy for me at that time, right? And because anyway, as a PhD student, you don't have a lot of money to spend on what you can eat, right? So this restaurant.com actually, faced some lawsuits on the actions of their CEOs, right? In terms of something similar with this rejection of acquisitions, right? So in this article, it explained a lawsuit by one of its equity owners on the company's previous CEOs, right? So the accusation is that the company was doing pretty well, and the sort of like the managers sort of mess it up, the CEOs mess it up. And also at a point of time, the company once had a valuation of $120 million, right? And in 2010, a joint venture offered to purchase a portion of Restaurant.com for 75 million, right? So at that time, the venture actually had a valuation of the company of around 120 million. But at the time, right, these two CEOs, right, Adam G and Chanel, right, they rejected the offer because he would have been one of the 5 corporate directors, right? So if they accept the offer, right, it means that they will sell their company to this venture, this joint venture, right? So if you sell the company to the venture, they will lose their status as, you know, sort of like board of directors or CEOs of the company, right? Because it's very likely that after you sold your company, you will be replaced by someone from the buyer, right, from the acquirer, right? So because they don't want to, you know, step away, right, or step aside as sort of a controller of the of Restaurant.com, right? So they rejected this acquisition offer of 120 million, right? And then what happened was that, you know, in 2015, right, under very bad management, the company received another offer to buy Restaurant.com, but at that point of time, the value of the company was only at $2 million, right? So essentially, what it means is that, first of all, the guy who filed this lawsuit against this CEOs of Restaurant.com was very disappointed by the management of the company, right? And second of all, it is very disappointed and upset by the decision of the CEOs of rejecting, right, this bid or this offer to buy the company at a very high valuation, right? And then they messed the company up, so the company is only worth of $2 million a couple years later, right? So this is what the lawsuit was about, right? So and this is, you know, hopefully this shows you an example of, you know, sometimes companies, CEOs and managers do not want to step away from the perks that they get to enjoy from the company, right? And they will do they will make certain decisions that's actually that actually hurts, right, its existing investors, right? So for example, one example here is rejecting the acquisition offer, right, which is pretty handsome offer. And you know, if you know, companies acquired, the existing investor can actually realize, you know, can exit their investment, right? Remember, and you know, get a very high return on their investment, right? Which is actually pretty good. So at that point of time, it was a bad decision from the management, right? So these are 2 examples of managerial entrenchment, right? Again, meaning that, you know, taking bad decisions for a company because you know, of at their own benefits, right, at the cost of their investors, right? So another one, right, which is also related to the conflicts between managers and equity holders, is what we call moral hazard, right? This one is more easy to this one's easier to understand, right? It means the idea that the company's managers makes decisions that is driven by their own pursuit rather than the entire shareholder, right? It's sort of similar with managerial entrenchment, but you know, more apparently related to their own interest, okay, instead of, you know, related with the fact that they do not want to be replaced, right? So for example, they may take bad decisions and that may benefit themselves, right, at a shareholder's expense, right? So let's say you open a company, right, and your uncle has another company which makes supplies of your company, right? So you decide to buy supplies from your uncle's company instead of you know, using the best bids, right, from the market, right, from the market. So in this way, you know, the decision of, you know, purchasing a supply from your uncle's company, right, will be, you know, benefiting your uncle, right, and also potentially you yourself, right? However, at the cost of you know, the other investors for the company, right? And another very simple example is that, you know, they might just not make the best effort, right, in making the decisions, right, in managing the companies. They might also abuse the company's cash, right, for their own good, right? For example, they can get a private jet, right? With the the excuse of it make it more convenient for them to attend meetings, right? Less costly, right? Less time consuming. However, uh, from a report, right? From a report, I can remember a couple years earlier that actually the company's private jets, right, instead of going to meetings, actually travel the most mileage to certain private islands or vacation places, right? Instead of big cities, right? Instead of the customers or partners companies. Okay, so also a restaurant example shows that the CEO actually, right, after making a very bad performance, right, showing a bad performance of the company, actually increased their own compensation, right, after increase their own increase their own compensation, right. So this is certainly at a cost, right, and irrational decision, right, at the cost of investors. So what can we do about this equity holder manager conflicts, right? What can we do to mitigate this conflicts or these bad decisions, right? Because of the separation of ownership and control, right? So in this way, that right that can be helpful, right, to sort of alleviate these agency issues, right? Remember we're talking about agency issues, meaning issues arising from agencies, different incentives, right? So in this way, right, issuing debt can, to some degree, alleviates this agency problem, right? Imagine why, right? So if the company start issuing debt, right, what happens is that the company will have less of cash, right, which could be abused by the managers, right? And also the managers needs to ensure the company is in a very good shape in order to pay back the debt, right? The manager does not want the company to go default and on the debt, so it get replaced, right? Because if you want to stay as the manager, you want to make sure the company is working at least properly, right? So in this case, right, increasing the level of debt can sort of mitigate this agency issue because of managers large ownership, however, large control, however, small ownership. Right? So issuing debt instead of equity will keep ownership more concentrated, first of all, and then they will maintain the monitoring power, right, from shareholders, right, which is another reason why debt can be helpful than equity, right, in this case. Right. The main reason is the first one, right? It forces the company to pay out the cash, right, to the debt holders, right, which reduce the remaining amount of cash that the managers can use, right? So if the manager has a limited amount of cash, right, then probably it will not spend them on wasteful projects, right, or buy private jets, right, for themselves, right? So a lot of times those moral hazards happens when the company is sitting on a pile of cash that is too much, and to reduce the amount of debt, or to reduce the amount of cash, right, that can be helpful. Okay, so that's sort of like the first conflicts, right? The first type of agency issue between managers and equity holders, right? So the second type of agency issues is related with two other different agents, right? So it's between the equity holders and debt holders, right? So it's not between the managers and equity holders anymore, right? It's the equity holders and debt holders, right? And we have mentioned this before, right? So they might come up with different decisions, right, in investment, if we have a sort of a different capital structure, right? So when a firm is in a financial distress, right? For example, when the leverage is too high, right? Then the firm might, run into, the issues as the following, right? So the first one is what we call underinvestment or, debt overhang, right? These two are the same, right? The second one is called overinvestment, right? Which is also called risk shifting, right? And the last one is something that's called milking the property, right? Or asset stripping, right? We'll explain each one, okay, one by one. So first one, debt overhang, right? It means that when you have too much debt, right, to pay, and the company is actually in a financial distress, then a lot of times the equity holders will, instead of taking good and safe project, will actually engage in, um, oh, okay. So debt holder hand means that, the underinvestment, right? So it means that the equity holders sometimes will let go of the good projects, right? Even if they have positive net present value, right? We'll explain why is that, right? And on the other side, right, they will likely have the incentive to take actually very risky projects, right? Even though those projects are bad projects with negative net present values. Okay, so this is about over investment, right? So essentially, if you combine these two, it means that when we have too much debt, right? When the company has too much debt, equity holders will actually take risky projects instead of safe projects, right? And this is actually at the cost, right? At the cost of debt holders. Okay, and finally, milking the property means that at some specific point in time, right, when the equity holders believe that it's just impossible for the company to pay back its debt holders, right? And what would you do as equity holder? You will sort of extract or exploit the remaining value of the company, right? And give it to themselves, right? Give it to yourselves before the company went into bankruptcy, right? And so this is even worse to the debt holders, right? Because those values are supposed to be, the money that goes into the debt holders' pockets, right? So in this case, this is what we call asset stripping, right? The equity holders strips away the value of the remaining assets of the company before it declares bankruptcy, right? Which is at the cost of the debt holders. Okay, so let's first use an example to explain underinvestment, right? Meaning that why would equity holders, right? I mean, remember, the owners of the company are the equity holders, right? And the equity holders are the ones that decide for the firm what kind of project to take, right? So in this case, why would equity holders decide not to take good investment, right? Good and more likely safe investment for a company with positive net present value, okay? So let's suppose we have a firm that don't have any cash, okay? It has a high amount of debt. Let's say it's $5,000, or you think about it as $5,000 million, right? It's also okay. Let's say we have $5,000 of debt, right? A large amount of debt. Shareholders right now have two options, right? So it can first declare bankruptcy because there's no way the company is going to pay back the debt, right? Has no cash at all. So if the shareholders declare bankruptcy at this point of time, they will get nothing. Okay, they will get nothing, right? The remaining value all goes to the debt holders, right? And if there is any. And the second option of them is to raise more capital so that they're willing, right? They are able to invest in the project that is a positive net present value, right? That has a positive net present value. Right. So the way to do that is that they can raise additional capital by issuing additional $1,000 of equity. Okay. So after they raise this additional $1,000 of equity, the company will have $1,000 cash, right? And $1,000 more of equity, right? So if they have raised this amount of money, they can invest in the project that will actually return them with a payoff of $5,000 and $500. Right, with 100% probability next period, right? So let's say there's sort of like a dream project, right? A very good project, which would have a very high net present value, right? Project that you can actually take, right? If you have $1,000 in your pocket, okay? So let's say we have a discount rate that is 10%, okay? So the net present value of this project will be, minus 1,000, which is your investment right now, plus 5. Well, let's say, well, do we assume a discount rate here? Okay, let's assume there's no discount rate, right? Okay, let's assume the discount rate is 0 at this case. Right, let's assume there's no discount rate. Right, meaning no time value of money, right? Just to make the case simple. Assume no discount rate. Right, what will happen is that you're gonna invest $1,000 and you're going to receive $5,000 and $500, right, next period, right? And so together you will the net present value of the project is $4,500, which is positive, right? It means that it's a very good project, right? Which means that if you are thinking about maximizing the firm value, right, this is something that you should actually take, right? So this investment increased the firm value by 4,500, right? So the firm will use $5,000 to pay off debt and will not go into bankruptcy. Right. So if the company takes this project, right, meaning that the company invests $1,000 from the equity holders, right, newly issued equity, and it will get back $5,000 and 500, right? It will receive $5,000 and $500, right, from the project, right? So what they can do then is that they can use the $5,000 from the payments of this project to pay off their debt, right? And the company at that point of time will not go into bankruptcy anymore, right? And there's a remaining $500, right, to the equity holders, right? So this seems a very good decision for a company, right? A very good opportunity for the company to get rid of its debt, right? And if equity holder is thinking of the best of the company, the equity holder should actually take this investment project, right? Because it maximizes firm value, right? And avoids the company from going into bankruptcy, right? However, if you think about equity holders, right? If the firm does not do anything, both debt holders and shareholders will get nothing, right? Both of them, right? No value of the firm, right? No cash at that point of time. They get nothing. However, if the equity holders allows the company, right, to take the risk-free project, which costs $1,000, meaning that equity holders would need to come up of $1,000 from their own pockets, right? And for that project, debt holders get $5,000, right? However, the shareholders only get the residual $500, right? So if you think about it from the equity holder side, I provided $1,000, however, I will only receive $500, right? So if you think about the equity holders, it's actually a bad investment project for themselves, right? Although it's a good project for the firm, it is something that's has a negative return for the equity holders, right? Because if they don't do anything, they get nothing, right? It's a zero return, right? But if they contribute $1,000 into a company and they will only receive 500 back, it's a negative return project, right? So the profit to the shareholder is actually a minus $500, right? So in this case, if you are the shareholder, right, as a rational shareholders, you will probably not do this project, right? Because essentially you're contributing $500 of your money to the pockets of debt holders, right? So this is a simplified example of underinvestment, right? Of underinvestment at the point of time when companies facing financial distress, right? Equity holders will not be willing to take those safe projects because they know that the additional money they provided will actually go into, most of them will actually go into the pocket of debt holders, right? So it is not worthwhile for them to do the project, right? So the suboptimal outcome will be that neither shareholders and bondholders, right? The shareholders will decide to not take the project, so the company will go into bankruptcy, right? So that's sort of the outcome, right? So this is why we call this debt overhang, right? Because of the amount of debt, right, hanging there, preventing the equity holders from making a decision that is bad to themselves or even at the benefit of the company, right? So this is how to think about underinvestment, right? So on the other side, how do we think about overinvestment, right? So overinvestment means equity holders will actually prefer to take project that's actually riskier and sometimes a bad project with negative net present value. Okay, so let's say a company has $1,000 in cash, right, and $5,000 of debt, right? So different, a little bit different from last case, right? So let's suppose the company already have $1,000 in cash, right? 5,000 of debt, right? So there are two options, right? Also for equity holders, right? So they can either go bankrupted, right? Pay this $1,000 to the bondholders, and they receive nothing, right, for themselves, right? Because this $1,000, if the company goes into bankruptcy, belongs to the debt holders, right? Or for another option, they can actually invest this $1,000, right, in a project that has a very little probability, right, very small probability of very high payment, and a very large probability of a small payment, right? So if you think about this, the net present value of the company, right, should be a negative 1,000 plus which is the investment, right, plus the probability of getting $20,000 plus the probability of getting a $0 times 0, right? So the net present value of the company, the outcome is negative 600, right? Which is a negative net present value project, meaning that as a rational investor, you should not have taken this project, right? Because it's a risky project that has a negative net present value, right? However, if you think about equity holders, they might just want to take the project, okay? And why is that, right? So if you think about it, there are two options for equity holders. Well, first option, they get nothing, $1,000 paid to the bondholders. Second option, right? They can take the project and actually gamble, right? And actually try to gamble that the project might just, happen to have a 2% of $20,000 in payment, right? Because what's the loss, right? Because what's their loss if they pick the second option? They'll still get nothing, right? So there's no loss for the equity holders to gamble on the second option, right? To gamble the $1,000 on the very small likelihood of this, negative NPV project, right? That is going to return a payment of $20,000, right? Does that make sense, right? So the equity holders, either way, right? So let's say the second, for taking the project, a large probability that you're going to waste $1,000, right, in the project and get nothing, right? But either way, the equity holders is going to get nothing, right? So why not just try, and maybe the project can actually return you something, right? So this is why we have this situation which is called overinvestment, right? Sometimes when you have a high leverage ahead of you, right? When you have a high leverage, and the company is there's a likelihood for a company to go into bankruptcy, right? The equity holders might want to abuse, right, or even gamble the remaining value of the company into certain wasteful project or bad projects, okay, because they get nothing to lose, right? Even when the company file bankruptcy, they get nothing, and when companies incur the failure in a risky project, they still get nothing, right? However, there's a slight chance, right? There's a slight chance that maybe investing in this risky project, right, the equity holders can actually get something out of it, right? Can actually get something out of it, right? So to illustrate, right? So let's say if the firm does nothing, goes into bankruptcy, debt holders get 1,000, equity holders get 0, right? If the firm takes a risky project, right, a very small probability, right? Expected value of debt holders, right, is very, very low probability they get their 5,000 back, because the company with a probability of 2 will going to generate $20,000, right? So they can actually get the payment of their $5,000 from that $20,000, right? However, in a more with a larger likelihood, they're gonna get a 0, because on the other side, the money will be wasted entirely, right? So their expected value, right, will be $100, right, using these two probabilities. Right? However, the expected value of equity holders, right, will be 2% times the residual, right, from the $20,000 after paying $5,000 to the debt holders, right, which is $15,000, plus the likelihood of also get nothing, right? So the expected value to equity holders of taking the project is actually a positive number, right, which is $300, right? Like what we explained, right? Like what we explained, there's might be a slight chance for equity holders to get something from it, right? So in this way, right, this overinvestment scenario will happen, right? The shareholder will actually choose to invest in the risky, negative, wasteful, whatever negative word you put in front of this project, right? Since their expected payoff is actually higher than zero, right? However, it is very likely that the bad outcome is going to happen, and in that case, right, the company essentially wastes $1,000, which could um, you know actually go to a debt holder's pocket, right? Because why would the equity holders care anyway, right? So this is why it's also called risk shifting, right? This is also called why it's called risk shifting, because equity holders essentially are shifting the risk of the project on the head of debt holders, right? So without taking the project, the debt holders has no risk of receiving $1,000. However, equity holders decide to gamble the remaining value of the company, right, and shifting, and shift the risk to debt holders, right? So the expected value of debt holders, dropped from $1,000 to $100 only. Right? So this is about overinvestment, right? So together, from the previous example, we know that when company is facing bankruptcy, right, it will likely uh, encounter both underinvestment, meaning foregoing good projects, and also overinvestment, meaning engaging in risky projects, right? And it is at the cost, right, of debt holders, right? Those decisions are made by equity holders, right, at the cost of debt holders, right? So the last one is simpler, right, to understand, right? Milking the property, right? Suppose our firm in the last example had $1,000 in cash, right? And if you are equity holder, right, you probably want to think about some certain ways so that you can actually get something out of $1,000 instead of paying it all to the debt holders when filing bankruptcy. Right? So if they cannot take, or do not have the option to take any risky project, right? One thing they can do is that, well, we are the equity holders, right? We decide what the companies can do, right? Why don't we make the decision, right, to let the company give ourselves $1,000 dividend, right, to the equity holders, right? And a lot of times this happens, right? So let's just issue the dividend to ourselves with remaining $1,000, and then leave nothing to the debt holders, right? So this happened actually in the real life, right, with the Eastern Airline case. Right? There was a significant asset stripping, right, actions, right, decisions happened during the course of Chapter 11, right? So even when the company filed for bankruptcy through Chapter 11, their existing equity holders, right, start to strip the asset value into their own pockets, right, and left only a very little amount to the debt holders. Right. So it lost about $2 billion in value, right, during bankruptcy, during the process of going through bankruptcy 11, Chapter 11, right? And only 38 of pre-bankruptcy firm assets was in the end distributed to the creditors, right, or to the bond owners, right? And the rest all used to fund the operating losses, right? Basically, the firm played poker with creditors' money, right, with full approval by the court, right, in this case. Right? And another reason why debt holders would rather not the firm to go bankruptcy, right? So a lot of times, because of this costly procedure, right? So the existing debt holders will want to renegotiate with the with the borrower, right, on the terms of their debt, right? So yes, let's say you cannot pay back all our money, right, this year, right? So why don't we give you an extension period, and maybe after you are doing well, or after you're doing better, you can pay us next year or 2 years later, right? So this is a lot of times happen, right, between debt holders and equity holders, right? To avoid all this agency cost, right? That would happen, right? That would have happened, right? So that it can at least maintain some level of firm value, which is actually better, right, for debt holders. Right? Remember these three, types of agency costs, right? Overinvestment, underinvestment, and property milking, right? So these are three examples of agency issues between equity holders and debt holders, right? Equity holders and debt holders, right? We talk about, in this case, these are all related with corporate governance, okay? So these are very good examples of corporate governance, right? Meaning that there are certain ways, right? Or basically there are a lot of conflicts, right, between different parties of agents, right? Different parties within the company. Okay, so the first one we talk about is between managers and equity holders. Second one is between equity holders and debt holders, right? And take a guess what the third one is about. Okay, it's not between managers and debt holders. However, it's actually between the insiders and outsiders, right? The insiders and outsiders, right? So in this way, in this case, right? In this case, a few things are related with the conflicts between insiders and outsiders, right? So if you think about who the insiders are for a company, they are generally the people who have more control of the company, the people who have a higher ownership of the company, and the people who who get to know the company better, right? So they could be the CEOs, the managers, right, and even the board of directors, right? Meaning a lot of board of directors are large shareholders, right? Representatives of investors, right? And finally, you could have some important employees or the personnel of the company. For example, there are accountants, right, who has access to important firm information, right, before the outsiders, right? And if you think about outsiders, right, you can think of as retail investors like us, right? So if you own shares in Apple, then you're likely the last person who knows about Apple's major decisions or important informations, right? So minority shareholders, right, in another way, with less voting rights, right, less control of the company, less information about the company, and less monitoring power, meaning that you basically have no control on what Tim Cook can do, right? On what Tim Cook can do with Apple, right? You can just follow, right? You can, right? There's very limited amount of stuff that you can do to influence the company's decisions, or incentivize any people within the company, right? So some examples of insider-outsider conflicts, right? A very straightforward example is insider trading, which we talk about in the class, right? So some people, right, with the inside information, with private information of the companies, might trade the company's securities, right, at the cost of the outsiders, right? For example, if the company is, for example, let's say the accountant, right? If you're accountant of Apple and you're doing, the financial report of Apple for, the previous couple of years, right? And then that before the earnings announcement was released to the market, that Apple is having a pretty good season, right? In the last quarter. So one thing you can do is that you can tell your, husband's uncle and his parents to buy Apple's shares. So sometimes it's not that easy to identify the information source of certain trades, right? So sometimes it's very hard to convict the activity of insider trading, right? Because there just can be so many connections in between, right? In between the people who has the information and the people who actually commit a crime, right? So, or who actually was involved in the trading, right? So if you do that, right? So why is it at the cost of outsiders, right? So if you buy the shares before the good information of the company is released, right? You essentially increase the cost, right? You essentially increase the cost of outsider investors to buy it, right? And after driving up the price, right? You drive up, essentially you drive up the price, right, earlier than the outsiders, right? And as for other investors, the shares will become more the shares will become more expensive for them, right, than what it should be, right, for Apple. right? And a lot of times, right, if your company has bad news, right, and you essentially jump off the ship, right, before others could, right, which is also taking advantage of the outsiders because they do not have that information. Okay, so it's illegal, but sometimes very difficult to convict, right? And another example, right, of insiders taking advantage of outsider investors, is that sometimes you can the large shareholders, right, the board of directors and the managers, they can sort of collude, right? They can sort of collude and make their compensation packages very good, right? However, the company situation might not be as good. Right? So restaurant.com is one example, right? At a time when the company was not doing very good, was not doing very well, the manager actually made the decision to increase its own compensation package, right? Which is certainly at a cost of their investors. And here there's another example which is quite interesting. Okay, this company is called Humana. It's a healthcare company. Okay, so let's take a look at what this company, Humana, right? Humana or Humana, what this company has done. Right? So this company, how does total compensation for Bruce? Okay, so we let's scroll down. Okay, so here's a case, right, which we see in Reuters, right, which we see on Reuters website. So this is in, let's take a look. This is what happened in 2015, right, December 2015. So when health insurer Humana, right, reported worse than expected quarterly earnings in late 2014, right, including a 21% drop in net income. So the company was doing pretty bad in that quarter, right? It softened the blow by immediately telling investors it would make a 500 million share repurchase. Okay, that's kind of weird, right? Let's take a look at why. In addition to smoothing shareholders, the surprise buyback benefited the company's senior executives. It added around 2 cents, right? It added around 2 cents to the company's annual earnings per share, right? Why would it add 2% to the annual earnings per share, right? Earnings per share is calculated by the amount of earnings divided the number of shares, right? Divided by the number of shares, right? So if you buy back 5 million shares from the market, it means that the number of shares outstanding will drop by 5 million shares, right? So essentially, the decrease in the denominator of EPS will increase, right, the value of EPS, because it's not because your earnings is higher, it's because your shares outstanding is smaller, right? Allowing, right, more importantly, allowing Humana to surpass its 7.50 EPS target by a single cent. Okay, and unlocking higher pay for top managers under terms of the company's compensation agreement, right? So what does that mean? It means that, okay, to incentivize, right, we learned that for CEOs packages, there's not only a flat, salary, right? You also want to give them some incentive so they can work harder for the company, right? So one of the incentive you can give the company is, something that's, called a bonus, right? And how do you activate, right? How do you activate that bonus? Right? So there are certain standards, right? So one of the standards that are frequently used is called EPS, right? So what it means is that, if the company succeeds in achieving EPS, right, which is higher than a certain amount of value, right? So in this case, 7.5, right? Then the CEOs will be, rewarded with a bonus, right, which is defined in the compensation agreement. Okay, so in this case, to unlock or to activate this bonus, right, what the CEOs has done is outrageous, right? It's phenomenal. Okay, so instead of making efforts to increase your earnings, what the CEO has done is, well, let's maybe do something with the denominator. Let's buy back shares outstanding. Let's do a share repurchase. Okay. What happens after that is that, the denominator of shares outstanding is going to decrease, right? So that the value of EPS will increase, right? And then what's even more shameless is that the amount of share repurchase, right, allows the number just to bump up, right, 2 cents above, right, 2 cents above the 7.50 EPS target. Okay, so that's just shameless. Okay, so you see that there are a lot of stuff that the senior executives or the CEOs can actually do, right? Can actually do for their own benefits. Okay, so at a point of time when a company is not actually doing very well, the CEO is still willing to spend money, right, from the company just to achieve its own target of the compensation bonus. Okay, so this is actually what happened, right? This is actually what happens of like a great example of overpaying compensations. Okay, of overpaying compensation. And if you think about who makes those agreements, right? Who makes this compensation packages agreements, right? It's actually the people who hire the CEO. Okay, and who are the people who hire the CEO? The board of directors. Okay, so the board of directors. So there's actually a quite large incentive for the board of directors to sort of collude with the CEO on what they can do and they cannot do. Okay, so in this case, right, because the insiders agreement on the package of the compensation, right, actually something funny, right, really funny and shameless that the CEOs actually have done is to is to play around the EPS measure, right, using the share buyback. Right? So this is of course one of the issues between insiders and outsiders, because there's very little thing, right, that retail investors or small or minority shareholders can do, right, in this case. However, the money has gone into the pockets of the CEO, right? So you can also think of this as sort of a moral hazard issue, right? You can also sort of think of this as a moral hazard issue. The CEO is doing something for themselves, right? So some examples for this insider-outsider conflicts, right, can also be thought of as moral hazards of CEOs or managers or large institutions or large shareholders, right? And in the end, right, and because there's this information asymmetry, right, different access to information on the company, right, there might be certain incentives, right, for the company's insiders to delay the disclosures of crucial information on the company, right? So an extreme case is that the companies wants to hide some illegal activities, right? Want to hide some type of bad information that could potentially hurt the company's valuation by a lot, right? So a very famous example is here, right, by Wells Fargo, right? So what happened in Wells Fargo? If you know that, well, probably happened a couple times some time ago. So let's take a look. Sorry, it's taking a while. I think I have something here, I think. Oh, this one, right? This one. Cancel this, right? So one of the seven greatest financial frauds in history, right? So Wells Fargo ranks one among them, right? So what happened was that while most of the fraud on the list was committed by C-suite executives, right, the case of Wells Fargo is a bit different, right? To be fair, it is clearly the fault of the company's higher up that employees at Wells Fargo were given impossibly high sales goals that rose like clockwork, right, from 2002 to 2016, right? So they're expected to make really high sales, right? But to meet those quotas, employees at the bank were incentivized to open fake accounts under customers' names. If a customer opens a savings account at a bank, employees might, open a credit card under that customer's names as well. Short-term profits soared thanks to more than 2 million of these fake accounts but it wasn't worth it in the long run, right? Wells Fargo will pay $3 billion in fines to the U.S. Securities and Exchange Commissions and Department of Justice, right? Who knows when the customers will be fully trusted the bank again, right? So this was what happened between for like a credit crisis, right? For Wells Fargo, right? A reputation crisis. Right? So some others include Volkswagen, right? Who hides the information on the test, right, of its emissions, right? So test on emissions, right, just to bypass the law, right, because it will save them a tremendous amount of money, right, without having to put the extra technology or extra piece, right, into their car, into their vehicle. Right? So those are stuff, right? Only the insiders know, right? Outside investors have no knowledge, no access on certain stuff like that. And a lot of times, right, the insiders will have the incentive to keep those information, particularly negative information, right, from outsiders. Okay, so this is this sums up the wraps up the third friction, right, which is on agency costs, right? Again, we have different type of agency costs, right? Meaning, agency issues between managers and shareholders, right? Between equity holders and debt holders, and also between insiders and outsiders, right? Some of them have a similar rationale, right? Some of them are very different, right? Differently motivated. Okay, so if you consider, right, adding the third type of friction, right, into our decision, right, in capital structure, then you sort of like fill the picture, right, with another ingredient. Right? So on the left hand side, right, the benefit of raising debt, right, right, start from tax benefit to also, if you remember, limiting the perks, right? Limiting the cash, which is accessible to CEOs, right? So that they don't waste this cash on wasteful projects, right? So they it can sort of also alleviates the empire building issues, right? From those CEOs, right? On the other side, the cost of debt, right, increases from financial distress, right? Increases from also the extra payment, right, the amount of payment on interest expenses, to also include the excessive risk taking, right, or over investment, and also the debt overhang issue, which is about underinvestment, and also the other stuff, right, we have talked about, which is included in the agency cost. Right. So now we have a better and better pictures, which is closer and closer to our real world on how firms make decisions on the capital structure, right? On the capital structure. Okay, so last one, right, I want to talk about is asymmetric information, right? We sort of mentioned it when we talk about SEO, right? Seasoned equity offering, right? What we said at that point of time is that when companies decide to do both IPO and SEOs, right, it means that generally the company believes the market has a relatively high valuation of the company, right, which is one of the rationale why it needs to finance through equity, right? So asymmetric information in this case means that the insiders of the company, right, as we described, has more information than the outside, right, the outsiders, right? So in the perfect world, we assume they know everything, right? They know everything. They share the same information. But in the real world, it rarely do. Right? They rarely do. And okay, so asymmetric information may motivate the manager to alter the firm's capital structure, right? Because they know that, right, issuing through equity is sort of a bad signal, right? It's a sort of a bad signal to the market, right? Because issuing equity sort of suggests that the insiders believe the company is sort of overvalued, right? Then it will be at a higher cost because the outsider investors will take that signal as what motivate their own decisions, which is probably to sell the equity instead of raising equity, right? So this essentially makes the equity raising more costly, right, or more difficult for a company, right? So on the other side, right, we talk about how debt issuance is going to benefit the companies, right? Aligning the incentives between CEOs and equity investors, right? So in this case, there's also another benefit for debt issuance, which is actually by issuing debt, right? It signals the manager's confidence, right, in the firm's ability to make payments to the debt holders, right? So it suggests that the manager believes that the company is in a very good shape, and the increasing amount of debt will have no problem in affecting the company's business. Okay, so debt issuance in this case is actually a positive signal, right, for the market, right? And when the market receives the debt issuance signal, it will, generally react positively, right? Meaning that after issuing debt, generally you will see a positive stock price reaction, right, from the market, right, from the market. So this is, what we think about in signaling theory, right? In signaling theory, right? Because of the asymmetric information between insiders and outsiders, right? Equity issuance is considered an inferior, right? An inferior action than debt issuance, right? In this case, right? So, if we add all these four frictions together, right? If we add all those four frictions together, we will come up with, a graph which is similar to the previous one, right? We know that, when facing the choice of financing, right, for a firm, right? Let's assume the first firm needs capital to make, investment, right? Then, the cash, right? Its own cash is the least costly thing for them to use, right? Although there's no benefits, right? However, using cash is the cheapest way, right, for its financing, right, using its own cash. Second, right, the company might want to refer to debt, right, if the financial distress, right, cost of financial distress is not that high, right? So the debt has this benefit of tax shield, right, and also is a positive signal to the market. And it also alleviates, the agency issues, right? Some agency issues, right? The only cost is that it will sort of increase the financial distress, right, of the company, right? And the last resource the company will want to use, right, will want to choose is to issue equity, right? The good thing about equity is no financial distress. However, the cost is that there's no tax shield. It's also a negative signal to the market on the firm valuation. And also it dilutes the ownership, right? And the cost seems to be more than the benefit, right? More than the benefit. So this is what we call the pecking order hypothesis, right? I have no idea why it's called a pecking order thesis. So it's sort of like it's an order of the companies in terms of choosing, right, or in terms of choosing its financial resources, or sort of like a preference for its external financing, right? So cash, right, which is actually internal financing, right? Cash is better than debt, and it's better than equity, right? And the firms generally follow this order, right, to use their financial resources. Okay, so this is pretty much about capital structure, right? This is pretty much about capital structure. Just a quick review, right? We started from a perfect world, like in physics, right, to understand how capital structure is related with firm value, and our conclusion is no, right? There's no relationship, right? So no matter how high your leverage is, your firm value should not be affected, right? Giving a perfect capital market. However, if we consider taxes, then debt has an advantage on taxes, right? Meaning that companies will want to increase leverage as much as they can, right? However, if we also consider cost of financial distress, then there might be a certain level of leverage which is sort of optimal to the companies, right? Depending on their nature, right? Because over that level, the cost of financial distress will likely be higher than the benefit from the taxes, right? And then we introduced agency costs, right? Meaning that different parties have different incentives, right? And based on their incentives, right, we want to, sort of add, different type of benefits and costs, right, into debt and equity, right? And finally, right, we have asymmetric information, right, based on, the signal, right, based on the signals that, different financing channels will send to the market, right? We want to sort of, also include right? The considerations of those signals, right? When making decisions on which one we should choose to finance, right? So our overall conclusion is that we want to use, we want to follow this pecking order hypothesis, right? Meaning that we want to first, right, turn to our own cash, right, if when we need capital, right, and then if we, do not have enough cash, we start from debt, right, and when we cannot raise debt anymore, right, because of financial distress, we turn to equity, right? We turn to equity, right? So this is overall, right, this is overall how capital structure is. Right? And you remember in the real world, right? In a real capital market, capital structure does affect firm value, right? It does affect firm value, and this is why we want to, sort of pick, right, to our best knowledge, an optimal leverage ratio for companies. Okay, so that's so much I want to talk about for this recording.